Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, May 21st, 2020. What I want to do is start out a quick look at the broad markets. I wasn't able to do a market recap yesterday. As I mentioned earlier in the day, I had to cut out yesterday and was out for most of the afternoon and into the evening, actually. So really not a lot to update yesterday, but I do want to go over some things today. Same charts I posted this morning, things to watch for here. The divergences, as I said, continue to build. And I know a lot of people get frustrated because divergences build and they don't play out. And sometimes they never play out. I always say that, but that's usually about 10-15% of the time where you have clean divergences on the index or security that they do not play out for a meaningful trend reversal or correction. But again, so that's trading. It's probability, odds, all that kind of stuff. Put it in your favor. But again, nothing's changed. This is a 60-minute chart, so you can see the divergences have been building. We keep inching up, extending the divergences on each new marginal new high in QQQ. I'll get to SPY in a second. And so the most recent trend lines are pretty well developed. These are the same ones mentioned the other day. Remember when QQQ in yesterday's update, actually day before yesterday on Tuesday, Tuesday evening, posted that SPY had broken down below a comparable trend line on the 60-minute chart, yet QQQ and the NASDAQ 100 futures at the same time hit support and bounce. So that's where we're at. And that bounce right there gave an extra check mark, or what I call, an extra validation, if you will, to the trend line. You had a lot of reactions back here, another distinct reaction there, which I like, separated from these. And here we are again today. So as I do the video, we are basically on support. As I said this morning in the update, you need to see both QQQ and SPY break down, and you need to see them do it impulsively with a solid 60-minute close, because you look at candlesticks. This is how I use charting. You can I like to have a solid 60-minute close. You can see here we broke that trend line intra-period, meaning within that 60-minute candle, to close right back above it, or on or above the trend line. And so that's what's happened so far. We had a little sell-off. There's a support level there. I don't know if you can make it out. I had that on the chart ahead of time. Let me turn it up, the color a little brighter, and you can see it about 229 and change. And reaction highs there, and that's what we hit. So where we're at, well, this candle's still in the works right now, and once it's finalized, if it's right here or right on or above the trend line, then that's not a sell signal. If it's down here, where it at the low of the lows today so far, about 229.17 or so, yeah, that would be a solid 60-minute close. Or if we get it 10 candles from now or 2 candles from now, that would be a sell signal. And again, that's one of the 2 major indexes that I try to or that I do follow, and the other is SPY. There's the official trade. I told you, one of the things I said, I was going to let it go. I wasn't going to revise this trade anymore, and especially yesterday, I wasn't here to the close to suspend the stop. So as I said, up to you if you wanted to give it a little more room on your stops. If assuming you're even in it, you could, if you want, you could take that breakdown there, that candle that did break down, add it here like that. This is the trend line I had before, but this is the chart I shared with you this morning right here, and that's how I had it drawn. This is the one I believe that I posted on the site earlier today. And so there it is. You have a breakdown in SPY, but once again, not the tech heavy QQQ. And that's what this market's been about. Everyone's just flocking in the market leaders. So we'll take a look at those real quick, because as I always say, until and unless tech breaks, a market will not break. I've done this long enough, and especially in recent years, it wasn't always that way, but now with technology, the tech sector being half of the NASDAQ 100 and a quarter of the S&P 500, by far the largest sector in both, you're not going to see a correction, any meaningful correction, without technology breaking. So we'll get to that in a second as well. And then on SPY, they've been flirting with that 295 level. That's around where our stop was. Took it out, but very unimpulsively, and that's where we're at. So there's a so far what looks to be a pretty decent sell signal on SPY. We just need the Qs to follow suit. I don't know what I did with that. There it is. And then we have our sell signals. And when we get them, keep in mind that I posted this morning, the minimum target I'm looking for is a backfill of those gaps. Now, what I said, hopefully that was clear. It's the first either or, because you have a different subset of traders. You have some traders that trade the Qs, some that trade the S&P 500. And you have others that trade the Dow. So you want to look at those because it depends which traders have the most amount of capital, if that makes any sense, or where's the largest number of trades. In other words, if QQQ comes down here and hits the gap first and the buyers step in, and remember, by the way, the top of the gap is also support. I'm just saying that minimum target, I think, if we get those sell signals, will be, again, bare minimum, a backfill the gap. You could certainly, if you believe the market's going to new highs. I know, you get more and more people clamoring for calls for new highs. Not that they were, not those that were saying it back here, but of course, after a rally, it's called recency bias. People think because the market is rallying and it's resilient and it's going up, that it's going to continue to go up, and that's just part of trading. Again, that's recency bias. So, like I said back then, you can't rule that out, but I put the odds at next to nothing that we'll see all-time highs, new highs in the broad market. Remember, QQQ is not the stock market; it's just pretty much a overweighted index of the market-leading FAANG stocks, a lot of technology stocks. The S&P 500 and the Dow, they're much closer to the stock market and the entire economy, and so that's what I'm referring to when I'm talking about new, taking out the February highs. So that's it on the Qs. If we were to backfill that gap right there, you're talking a pullback of about 3%. And then on the SPY right here, here's the gap down there from where we're at. If I can grab, measuring tool pops up to the left there, you're talking about 3.25%. And so therefore, like I said, it's the first of. And in this case, depends how any if we even get the sell signals to begin with, how it materializes. But you probably see QQQ hit that first, and the Qs could carry through there and SPY could keep going. It all depends, but again, these are just near-term pullback targets. But I wanted to say this again, this is the bigger, more important point, is the bigger picture, is that if these seemingly innocuous sell signals and gap backfills are triggered, what it does, and depending on how it looks, what does that mean? Well, how it looks, if we get a backfill, are they impulsive or are they not impulsive? Why? What's the difference? Well, let's say they were impulsive. Let's say it happened today, for example. That'd be a big drop, a big reversal. What would that look like then on the more significant daily charts? Well, here's what it would look like. I'm going to draw it out for you. And again, this is all hypotheticals. With the recent market action, it's hard to picture this happening, and it probably won't happen today. But if it did, that's what it would look like. And what's that? Well, that would be a big bearish engulfing candle that wipes that out. Or if it comes tomorrow. And again, and so that's just one of many scenarios. That's what I mean by how does it look. We may just keep going up from here. We may not even backfill those gaps. I'd be surprised, but anything is possible. So again, how it looks, if it took a while to get down there, it's not going to look as bad or have as much technical significance as a big move down. I don't think there's any market moving headlines left today, or economic reports or anything like that that's going to cause that today, but we'll see. And then, bigger picture also is the daily chart, the key 200-day exponential and simple moving averages. The 200, there it is, it's all turned up. Hopefully you can see it here in red. And like I said, some traders watch the 200 exponential, some watch the 200-day simple. I'd probably say more. It seems like probably more traders look at the simple. I like the exponential a little bit better, but again, doesn't matter what I like. It's where everyone else is looking. And this I've talked about. Yes, we're above the 200-day exponential, below the 200-day simple, kind of pinch between the two. But as I said, every other point in time, and I did this in recent videos, back in the previous bear markets, we came up, and this is where the first big bear market rally stalled out at, and I believe in every case it pierced that 200-day exponential and tested it for usually several days, which now it's done. It was 1, 2, 3, 4, and in most cases it popped it briefly and then fell back down below it. So that's where you usually, if you fall back down below it after recovering it or regaining it like we have here, that's usually where you start to see a lot of selling kick in, because they realize that was a false breakout, a failed recovery, and that's usually when you get your more powerful selling once the 200, once you move back down below, because again, it represents a false breakout there. So I've been saying this since back here and beyond, even before we got there, and nothing's changed technically for me. Is this one of the most resilient trends? It's at least in a while, but this is not anything new. It's just a resilient uptrend. Yes, the market has shrugged off numerous short-term sell signals, and even a more powerful. We had those bearish engulfing sticks a couple weeks ago. So I will say that right now the price action that was nothing but a check mark for the bulls, if you will. What I look at, and here's the way I see it. So I'll say, okay, check mark. If we had a bearish engulfing confirmed, that was check marks for the bears at the time. But then we recovered that level. We moved back above that bearish engulfing, so the bulls get a check mark. What this reminds me of, it's like the Thrill of Manila. It's like a fight between two big heavyweights. If you guys are boxing fans, yeah, every now and then you get a good fight where they're just slugging it out. Or okay, maybe not a boxing fan, you watch Rocky movies, and Rocky and Clubber Lang or Apollo Creed are just slugging it out, boom, boom, boom. One round you think one of them has it, the next round the other has it. Obviously, we know how the Rocky movies end, but you get my point. And this is kind of what's going on here with bulls and bears, if you want to use those terms metaphorically speaking, or buyers and sellers. And that's it. So bigger picture remains everything I've been saying for a while, and if and when that change, I'll change my tune. But that's it. We're just chopping around sideways at a point where historically, where most bear market rallies have ended after you've started a bear market, and by every metric just about out there, we've certainly started one back there. And again, if that was it, if you believe the market's going to new highs, and what you're seeing is history probably being made is the shortest bear market in history right there, 36% or so drop, a one and done bear market. I don't recall many of those. Maybe 1987 after Black Monday, that 25 something percent drop in the Dow, and then then the market, it did have a little more downside and then recovered. So again, you kind of get my point. Is it doesn't fit in with historical price action, going back hundreds of years. Bear markets are usually not, they usually last about 18 months at least, give or take, and not 1 month. That'd be quite unusual. So, all right, I've said my piece, and I've said it over and over, and that's where we're at. So that's the bigger picture, which has not changed and will not change, especially when I go to the monthly charts. I watch these levels. We're peaking above that 20-month exponential moving average. Last month, we effectively closed right about on it, and there's still plenty of days left in this month. It is May 21st, but a lot can and will happen. And the thing about stocks, I always say this, is they tend to fall a lot faster than they rise. So when the music ends, I'm talking this game of musical chairs, the music's playing, meaning the trend is up, but when that music stops, what happens is stocks tend to fall a lot faster than they rise. Once everyone realizes, if as I suspect it'll be the case, that the market cannot surmount these key levels, and that's when you usually get a pretty crowded rush for the exits. Longs take profits, shorts who have been frustrated and stopped out, or waiting maybe for a more solid sell signal, they start to pile in, and then in just a matter of days you can wipe out. And mark my words, I think this will happen. You will wipe out at some point here, I believe, in the next couple months. There are no guarantees, but I believe we'll wipe out months of gains. In other words, that whole trading range. So that's kind of what I'm talking about here. Is this multi-month trading range, goes back to early April right there or so, and I would not be surprised to see that wiped out in maybe just a week or so of selling. And that's how the stock market usually works. Just like back here during this drop, and I talk about that all the time, how that's what corrections and bear markets do, and the whole reason I love shorting is stocks tend to fall a lot faster than they rise. So there's an example where back from the February highs, and it's not the only one. It's a pretty extreme example recently, but there's many points in times where you wiped out from that point in just a month, just over a month. We wiped out all the gains that the market made for. You have to drag over here, really come back here. Yeah, we can go all the way back here. you wiped out 5 years of gains right there. Or we can go to this point. Let's just say that. Whatever. It doesn't matter. You get the point. 4 years of gains wiped out in one fell swoop. Same thing we did here. We wiped out, at that point, we wiped out, years, over a year of gains as well. So, and that's what I talk about, risk reward not being favorable, especially for non-active traders. 401k money and mutual funds. The thing about 401ks is, unlike, for active trading here, and I'm really zeroing in right now to get these sell signals today that I showed you on the homepage on that post earlier today. Let's look at NQ. NQ back tested, rolling over. ES needs to come really break these lows here. But if we get those sell signals, and you're an active trader, and let's say you've been long the SPY, and you see, okay, well, that's a pretty convincing sell signal. You can jump out. And then if everybody else realizes, wow, those are sell signals, by the end of the day, the market could be down 3% or more. And what happens is 401ks, you might say, okay, I'm going to get out of my 401k. I've been riding this wave up and caught a lot. And if you have, great, more power to you. But you put your sell order in. Guess what happens? Your sell order doesn't go in until the end of the day. You get the closing day price. So, or as an active trader can jump out of a long position or jump into a short, you can't do that on those type accounts, so mutual funds and 401ks, which usually have mutual funds in there. So that's it. And then what happens too is you tend to, oh gosh, the market's down 3%. I'm going to hold off putting my sell order in. I'll wait for a bounce tomorrow. And then tomorrow comes and the market's down again and again. And that's what happens. And it happens at the bottom. When people start to see the market move up and they think they should buy, but they're going to wait for a little more evidence. And here's how the masses trade. At the highs, they didn't want to sell. They want to start selling. They get worried here. They start selling out here along the way down. And then when the market bottoms, it has a bounce. They figure it's just another bear market rally. They want to buy. And finally, they start chasing up in here. The masses, they say, tend to sell at the wrong time. They tend to sell out down here just before the bottom, and they tend to buy in back towards the top of a rally. And then when the next thing happens, they're in. They probably won't start panic selling. And that's why, and that's the beautiful thing about bear markets, if this is one that we're in, is that, and that's the one thing about Elliott Wave that is probably the best wave count of those primary 5 wave counts. And the logic behind them always made sense to me, is that you have wave 1 down, wave 2 up, the P3, the primary, they call it P3, the primary third wave, and it works in reverse too. In a bull trend, you can have those waves going up, but the third wave is always the most powerful in a 5 wave. And then you have wave 4 and then wave 5 in the bear market. So this is not drawn to scale. And that was, that's what we saw in the last bear market as well. We had those, pretty decent wave count, 1, 2, P3 down right there, P4, and then P5. Okay, so the market, gave you my thoughts there. Trade ideas. This one, before I left my desk yesterday, I almost put this up as a trade, and then I knew I was going to be out, so I figured I'd hold off to today. And it's fine. We gave up a little bit. We had the breakdown yesterday, actually, Netflix. It broke down yesterday, and again, I wasn't around, so I figured I'd save it till this morning, and we got a pretty good entry. So you can see now there was a breakdown. Questionable, especially considering the trend now. That's nice impulsive follow through, so it looks good. And I had, on the daily chart, although the kind of the unofficial targets at 394.20, and then this 383.81. That's a yellow line because I called it the golden shorting line. We had numerous official and unofficial short trades. That was an official one there. I know those two were official. Milking these moves down. We covered that first one back there, jumped out, even went long on a few of these, officially or unofficially, I can't recall. But it's just been for years what again I call it golden shorting line. And then we took it out here, and I've been watching it. I even mentioned when it came up here, it might short again, and I didn't. It held off because of what was going on in the market and the recovery and everything else. But I've kept my eye on it, and then I watched this one set up in this nice divergent high right here, negative divergence on both the RSI and the PPO, just like we had back here, just like we had right here. There was divergence there. I don't have both lines drawn. You just have to draw it like that. And little divergence, little correction, bigger divergence, bigger correction. So that's that. And I think we come back down there and probably ultimately go on to retest the golden shorting line. But for the time being, I'll just give you some near-term targets. I know my guess is majority of people didn't take this because of the trend right now and how resilient the stock market's been. And I'll just say this: the time you want to short is when you don't want to short. Or I'm sorry, the time you should be shorting is when you and nobody else wants to short. When it just to that point where it seems like the market will never drop again and is only going to go up. Just like the time to buy is when nobody else wants to buy and you step in down here, or whenever the market was bottomed in the that's it. That was the bottom. That's when you want to step in and buy. And most people won't do it because again they're counter trend trades, and that's a big part of my style is looking ahead, trying to use what's on the left side of the chart to identify what will happen on the right side of the chart. And by that I mean, you take away all those time margins right there, the extra space. That's the right side of the chart. What's going to happen in the future, and looking at what's happened here, on the left side, everything from where prices currently are, kind of will give you, well, more often than not, will give you an idea where we're going to go. And so this has just been a series of uptrend lines that have broken, and with the market inching higher, and so it's shrugged off some bearish developments. We had just little corrections, but again, because nothing has changed in the bigger picture, both the stock market and a lot of these stocks, yes, they had divergent highs. Well, this one actually, Netflix didn't until now, and that's the other thing. I'm finally starting to see some of those market-leading stocks and even some sectors that didn't before have divergences. In other words, if the case was a bearish case could have been made back here, an even stronger bearish case, particularly on Netflix, because look, at this point we didn't have it. This high right here, we did not have any divergence. You were making higher highs on the momentum indicators. At this point, you made a lower high, prices made a higher high. That is the definition of a negative divergence right there. And then you had a little minor trend line right there that did the trick, and price support. So that was the whole basis of this trade. I wanted to see 447.22 go, as well as that trend line, and there it is. And then you have that, of course, impulsive selling. Doesn't guarantee it doesn't guarantee that the trade plans out or plays out, but it does increase the likelihood. So still a little meat left on the bone, about 3% to the first target, and about 8-9% from here to the second target, and from where we shorted a little bit above that. So if this is hit, that should make up for the loss on that's about what probably the loss on that SPY trade was. And if this is hit, I think it'll happen within just a couple days, within a week or so, well, probably less than a week is my guess. Again, if we get the sell signals on the broad market. Otherwise, and I did address this under the Netflix post, somebody asked, hey, is this a crack in the wall of a great V-shaped recovery, canary in the coal mine? I said, look, maybe. And you can't say that yet. What I'm watching for, and we're going to roll into this now, are the FAANG stocks. You need to see some of those market leaders break down. Now, Netflix, although it's not as top weighted as the other Microsoft, Amazon, Apple, and Alphabet and Facebook, it is certainly a market leading stock, a crowd favorite, if you will. When you see more and more of those leaders break down, then the greater the chance is it's going to lead to a meaningful reversal in the broad market. So let's look at that real quick. Let's look at the market leaders. Let's look at them on a 60-minute chart. In order of market cap, Microsoft, big dog, $1.4 trillion company. There's a trend line I'm watching. And, it's above trend, zero sell signals at this point in time. It's stalled out at its previous, just shy of its previous all-time high back in February, early February. Had a little reaction there. Now we have another reaction. So these are levels I'm watching for Microsoft. 1, 2, 3 failures around that 187.63 level after the stock put in an all-time high right there. This is a trend line I'm watching, so we need to see that trend line break, and obviously you can see, even better if we can take out 174. But as of now, no sell signals. But these divergences tell me that that this trend is, the the life is limited in this trend. Most likely, again, probability, statistics, we're going to have a meaningful reversal, and it's big divergence. In fact, these divergences now, the negative divergences in scope and duration, are bigger than the divergences leading up to the lows back here. And they're obviously much bigger than those leading up to the highs there. Apple already broke down, and a very well-defined trend line. Was a little impulsive at first, but came and caught support right there at 302.24, and it's had a little kickback rally. That kickback rally has done nothing, zero, to change the technical posture of the stock. In fact, if anything, it's still on a sell signal because it broke down below trend. It's just a little kickback rally to make a marginal new high, which simply extended the divergences they had in place before the breakdown. So because of that, I still see Apple going quite a bit lower. So the charts are set up just as they've been set up for weeks and months now, and because that hasn't played out doesn't mean that it won't play out. Doesn't guarantee that it will, but again, if I was bearish back here, I'm even more bearish now because I'm looking at even bigger divergences, and I'm looking at the stock market pushing the upper limits of really where bear market rally should have taken it, based on historical pops. Runs up there. Amazon, series of trend lines here, a little trend line there, a little break, a little trend line break, and same story. It's just inching up, extending the divergences, still very much intact. That's comparable to one of those short-term trend lines I showed you on the indexes a minute ago, and there's a breakdown that's impulsive as well on Amazon. See, nice big red candle, so far follow through. So what is that? We'll give it a little check mark here for Amazon right there, and you can see targets. This one's simple. I can tell you these are what I call high probability targets. They're very well defined support level. If you are targeting, you want to short Amazon, that's about a 7.25% drop, 2280 give or take. And then if and when that level goes, probably move down here, and that's about an 18% drop to about the 2000 level. So there's your targets for Amazon. Alphabet, we're kind of going to play around with these trend lines, but this is the most significant trend line now, the one in play, or the one to watch, right there. So again, this is almost identical technical postures, and it's not by coincidence because these are the top components. So when money flows into the NASDAQ 100 and the S&P 500, it flows into these stocks disproportionately. In other words, more money goes into these, and so inflows and outflows. And when everyone's buying and bullish, it's pushing the indexes up, and then other stocks are beneficiary too of that because there is so much indexing going on in recent years that even the lower tier stocks will also have some inflows into there. But it works on reverse when the tide changes and money starts coming out of the index ETFs and mutual funds, and these guys come under selling pressure. But technically, we need to see this trend line go in Alphabet. Yeah, it's the Class A shares. Here's the Class C shares. There it is. Nice, pretty clean uptrend line. And again, here's where the divergence is pretty much extended at this point. An equal or slightly higher high with indicators continuing to make lower highs there. All right, I think you got it. We'll extend this one out. Facebook's looks like, I don't know, maybe a little blow off top in the works. Depends with the market. If the market reverses, this will almost certainly prove to be a blow off top. Let's see, did it take out its divergences? And again, it's only 105, but no, about equal. That's about a flat line. Did take it out there on the PPO. Sometimes you have what I call it's just a term I made up called a wedge overthrow here. You have a rising wedge, and then you overshoot the wedge, followed by, if it's going to be a wedge overthrow, which it has that appearance now, you get a very sharp reversal back into and then down below the wedge. Do not stop it go. Do not collect 200, just like the game of Monopoly. It just usually just goes like that with very little. I mean, it might have a little kickback along the way, and then 231 is a big support level. If and when that goes, that's going to be even more powerful on Facebook. All right, that's it. That's the FAAMGs. Those are what we need to watch for. Of course, XLK as a whole. You can watch if you don't want to watch all 5 of those stocks. Watch the sector. XLK is a technology sector ETF. Same old thing, divergent high, little minor trend line there. So we need a little more downside. And to seal the deal, I think a break below 95 should seal the deal for to get a sell-off going. So those are the levels to watch. Other trade ideas, that silver I still like. You should have covered here that would as first an objective target. It's going to move down quick today, but remember I showed you this divergent high and expected silver to outperform gold on the downside. In fact, I told you I didn't plan to short gold, just silver. Silver's already fallen, what is that, 5% right there just in the last couple days. And it's at support now, or just tag support. Excuse me. So that's 17,258 target. So that was, offer you a quick level. Now, if and when that goes, which I suspect it may, see silver, although gold is a flight to safety asset, and that's why I don't care to short gold now because I'm expecting more downside in the market. Silver is more, they both have industrial uses, but silver more so. So with the market rallying, and that did go into my mindset before with I said back here that silver would likely outperform gold, which it vastly did. That was a big outperformance since the breakout here. I expect the same thing now on the downside, so I much more favor a short on silver and have than on gold. And if it takes that level out, next target's all the way down here, that'd be a nice drop to about 1652, and then maybe all the way back down here to 1598 or so. I was going to say to wrap it up here, but one more. Speaking of other assets, we'll watch Bitcoin. Seems to be breaking down, but I'll get back to this one later. I told you I'm watching this uptrend line. This is a daily chart here, but let me follow up on this. Let me study the charts a little bit further, the 60-minute charts and some other things, and then I'll give you any thoughts. Of course, if there are any Bitcoin trade, I know there's always a few Bitcoin traders on the site. All right, let's wrap up here, get the video out to you guys, and again, see what happens today. We've had plenty of short-term sell signals triggered in the past few months. Some of them led to little corrections. It looked like we were going to get more, and others just right after the breakdown, the market recovered. But like I said, the longer those divergences build, the greater the chances that we're going to have an even larger drop. So that's kind of where we're at. So we'll watch those near-term sell signals, and then if we get them, we'll assess the price action as it comes to how impulsive is the selling in the index in the indexes. Does XLK, the technology sector, break down? Most importantly, or as importantly, do those market-leading FAANG stocks, do they start breaking down, those that haven't already triggered sell signals? And so that's what I mean by assess the charts as they go. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.